All right, everybody. Hope you guys are having a fantastic end of the week. It's been interesting with the CPI reports and a bunch of other things that have kind of come out. The market's kind of taken a little bit of an upswing, which is pretty nice, considering we've been down pretty significantly. So, for those of you guys that are joining again to see the last 22 year-end 2022 dividends and stuff of the like, we're going to be going through the top 7 today. So excited to get through that. Excited to kind of share with you guys how well it's done. I've already gone through numbers 8 through 15 in a previous video, so feel free to check that out, just so we can concentrate. I've hid those columns and blown this up. I recognized, like when I was editing the last video, that I didn't blow up the spreadsheet nearly as much as I should have. So appreciate everyone's patience with that. But let's just hop right into it. I don't want to... the last video was pretty long, and I think a lot of it had to do with the fact that I was just working away and not really thinking about it. But here it is, man. Let's just hop right through. We have everything from XYLD, O, XYLG, Shell, Altria Group, Devo, Jeppy. And so let's go through quickly a little bit about each one of them. You can see, which is pretty interesting. I'd like to share that, not everything is 100% guaranteed to kind of come in as you would expect. Sometimes months get skipped, and sometimes you get double paid in certain months. And but as you kind of will see on the bottom here, where I've kind of moved and transitioned a lot of these funds to. So let's just hop over here. In the beginning, we'll just talk about XYLD for a second, and then we'll hop over to some of the others. So XYLD is actually something I ended up selling out of at the end of the year, and it's not horrible. It's not a bad fund. It's just I prefer something which you'll see, and I think in a couple little bits. So number 7 is XYLD. It paid me about $1,200, so just averaged $100 a month. But you can see towards the latter half of the year, the payments are starting to get pretty juicy, $150 a month or so. In the latter half of the year, it started dwindling down, and I think I actually at this point, I have zero dividends coming from XYLD on a monthly basis, and I think that has to do with the fact that I just don't need something that yields 7-8%. The portfolio is pretty expansive, and I'd rather invest in something that's a little bit refrained and maybe focus a little bit more on growth. Now, it obviously doesn't mean I'm getting rid of the dividend entirely, which you'll see in just a minute, but I think it just required a little bit of pullback a little bit. And the portfolio has matured a little bit. I'm not necessarily focusing 100% on the dividends of the world, which I would encourage most of you guys to think about as well. I'm not saying eliminating dividends, but I'm saying think about, is a portfolio with an 8% dividend yield something that actually makes you feel and sleep well at night, or something with 2.5 to 3.5% going to make you sleep a lot better? You hear a lot of 8% yielding companies cutting the dividend pretty frequently. You hear a lot less 2.5, 3.5% dividend yield is cutting frequently. So it goes back to that swan sleep well at night sort of discussion. So I encourage you guys to think a little bit about that. Realty Income. This is one that I'm going to hold for the short to medium term. Long term, I will get out of this position. And I think that partly is to do with the following. I think it's going to be challenged. So I might have to, as the current company is situated, I will say, I think it's challenged with the current environment for pharmacies. And I think that will continue to be a problem going into the future. Now, if they kind of divest out of these triple net, Walgreens, CVS sort of properties, then it might be something that I continue to potentially look into and hold on to. But a little bit scary, I think, in the future for those. And if I do eliminate some of this money in O, it would probably stick in the real estate realm. But of course, it all depends on the case point in time at which I'm, redeploying capital. But I'm fortunate to be growing dividends. I didn't add any to my O position this year. This is all dividend reinvestment, and it's all dividend growth. So we started the year off in January $112.65, and we ended December at $118.05. That was $120 year-over-year growth, and just under $1,400 in total for the year. So pretty cool to be able to be making $120 every single month from that. And you'll see that this one XYLG is one that probably grew throughout the year as well. So this $566 dividend payment, that is return on capital gains and stuff of the like. But this one is one that I continue to invest in throughout the year. You see it's a pretty much brand new position, $1,300. And I still maintain onto this one. I like this because it's very similar to XYLD, except it's only running covered calls on 50% of the equivalent shares that are under management. And the nice thing about this is if the stock decides to run, or if, say, the market decides to run, you're not going to get limited, say, 1.5%, 2% for the month. It'll grow a couple percent for the month, which XYLD, you'll end up with that cap because of the covered call that's on top. So if you're only writing covered calls on 50%, then you're going to be able to run a little bit further from a capital gains perspective. So $1,400 from that. I like that one. It's one I'm going to concentrate on. Personally, if I decide to need income, right now I'm kind of just pulling back a little bit on the income space. Shell, RDSB, used to be RDSB, now it's Shell, so I need to change that up a little bit. Throughout the year, I did invest some of my proceeds that came from Exxon, which I don't know if you'll see it on this list or it was on the previous, but took some of my proceeds from Exxon and put it into Shell. Get about $1,600 a year now, and I think that is up from up by 547. So it was only about $1,200 or $1,000 rather last year. So I think some of that is dividend growth. I think the majority of it is my investments into Shell. So I'm curious to see how that one proceeds going forward. It's going to be one that I anticipate holding on for the long term, but you never know. Then let's check. You have Altria Group here. So this one is one that I've actually sold out of the position. I know a lot of you guys are going to be upset with that. I just assumed, looking at it, I've, made decent dividends from it, so I can't complain. $264 year-over-year growth in terms of dividends. So I made just under $500 a quarter, and towards the end, I was making $500 a quarter. The reason why I got out of Altria Group, although I do believe that there's a great runway for the legalization of certain plants and stuff like that, that could be a huge tailwind for the stock. I just don't see it being a 3x, 4x, 5x over the coming years. Granted, I could be a dummy. Altria Group's been one of the best. If you had bought the original Philip Morris, I think it was the original Philip Morris company, it would have been one of the best investments you've ever made. Because I'm pretty sure it's Philip Morris, or maybe it's Altria Group, whatever. The one that spun off Mondelez, the one that spun off Kraft, the one that spun off Philip Morris, the international tobacco company. You have all these opportunities which have done so well. I just think that in the regulatory environment, whether or not you stick with the tobacco side or the other plants, I don't see it going 2x, 3x from here. So I think that it'll do well, but, I think that capital could be deployed better elsewhere. And so while the capital this held up, I'd say I got I think I sold at $53, $54 or something like that this year. Maybe I might be missing up my mind or something like that. But I took that opportunity, invested it in the S&P 500, and I anticipate that the long term of this will do really, really well. So that is something that in 10 years, I anticipate will grow by 2x. In 15, 20 years, it'll grow by 3x, those sorts of things. And yes, I'll still get a little bit of a dividend from that. So it's a shame next year we're not going to see Altria Group making a return in the 2023 equivalent video, but it lived its purpose. It held capital. I'd made money on the stock, and learned a little bit throughout its entirety. Sometimes it's not about getting rid of a stock, more as there's a better opportunity out there, and that's really what it was about Altria Group, and that's really what it was about Exxon as well. So two positions that I thought I would hold longer term, but at the end of the day, the S&P 500 is a much easier investment for me to own. So second to last is Devo. I like this one a lot. It was a new position for me. As I kind of alluded to earlier in my previous video, Dave and GW really were trying out Devo early on in 2021, and I did not really follow along until I sold out of, what was it? It wasn't QILD. What did I end up selling out of? Newsy. It wasn't until I sold out of Newsy in the second half of 2021 where I really started to dive deeper into Devo. And so I started off the year, I think, getting rid of Newsy and trimming down on some of these other positions and getting involved. You could see I didn't have any dividends come from Devo last year. So this was the first time I had built into the position. And so it's done really well. It's held up really well. I encourage people to look at it. It's 30 holdings that are low volatility. It kind of feels like a Dow industrial average, right? So it kind of feels like a Dow Jones. And they write covered calls on it. That's kind of how it feels, right? It's not 100% like for like, but it's kind of how it feels. 30 great stocks, large cap generally, and they write covered calls. And so it's not something I would shy away from. In fact, it's something that I wish I could do on my own portfolio if I knew how to write better options premium. So anyway, let's hop to the last position, and then we'll end up the video there. Maybe we'll do some additions. Maybe we won't. But this one's pretty impressive. Over $5,500 overall in JEPI. JEPI, it's a great one. And I encourage a lot of people to look at it. I think this one holds more like 100 or so stocks or something like that. Writes covered calls. I'm a fan. I say I could probably go in between Devo and JEPI. I can't really choose which one I would like and prefer right now. But JEPI's just the one I have the most in. And when I consolidated some of these positions, like the XYLD, the Ultra Group, I wouldn't be surprised if some of the money went into JEPI. Because you can see we were going about $250, $300 a month run rate. Now we're at $350, $450 a month run rate. So part of that obviously is JEPI has done well this year in terms of covered calls, but I think some of that is also just investment throughout the year and consolidations of the portfolio. You could see year over year, the position grew by $4,800 for dividends. So overall, yields about $5,500, $5,600 in dividends. One of these is in my Roth IRA, and that's why it's separated compared to my individual brokerage account. But it's pretty cool to be able to get $350, $400, and really it's not all that much money in there. It replicates to an extent the S&P, so it's not like a super low volatility or anything of the like, but it's just performed really well this year compared to the S&P, and the dividend is held in there. I don't anticipate the dividend holding on like forever that much longer, or the income coming from it that much longer, because obviously I wouldn't be surprised if the market goes up into the right, and maybe it might be better for cover calls. Let's be honest, who knows? But it all depends on how they're acting with the JP Morgan fund. Are they buying back these things early? What have you? So it all just depends on what they write and the time that they write it. So, but anyway, I'm a fan of JEPI. I like it. I like Devo, and I think both have held up really, really well for the time that I've kind of held them. So these are going to continue into the portfolio, the Devos, the JEPIs of the world. It's nice when you reinvest something that's like $350, $400 a month, and it's yielding 7%. You're going to end up with another $30 for the year. So you end up seeing another $2-3 every month from that reinvestment, which is pretty cool. So the hope is that continues to build and does well. And as I've kind of probably already alluded to for some of you guys, and maybe I haven't, maybe you haven't really heard me, getting after some of these people. I don't need a lot of the income, right? Like I'm still going to keep working, and I'm, doing really well at my job, and a lot of some of that stuff. So it's not like I need the income today. So I think, it used to be where I was really trying to ramp up the income in case I ever needed it, in case of being laid off or something like that. Now it's kind of the point where the portfolio size is what the portfolio size is. I'm not necessarily rushing out to buy every dividend that I can, and the reason being is if I need to adjust the portfolio a couple percentage points, like let's say I'm unfortunate, I lose my job, I can adjust the portfolio to be more focused along with JEPI. We saw some things like Caterpillar and a few other positions in there that don't yield nearly as much as a JEPI or a Devo. If I truly need that income and need to survive or something of the like, and say I have to go a couple months without a job, and then I'm like, oh man, am I ever going to get a job? Is the recession that bad? I'd put some of my money into JEPI to get that extra income or that buffer, at least make me feel a little bit more secure. But I have that capital in the portfolio now. I didn't used to. And so I think it all just depends, as always, your perspective and what you're looking for, right? If you're looking for something that is more secure and makes you sleep well better at night and gives you that income and that makes you feel good, then that's okay. But I think what you need to recognize is in somebody's perspective like mine, who's gone from zero to, however much I've gone to now, 7-figure range, let's say, just for ease of it or for the conversation, is, I missed out probably on hundreds of thousands of dollars likely because I was so focused on the dividends of the world, where people were like, but how are your capital gains though? And I was like, I don't care, man, the dividends. But in reality, where I would be today, maybe I wouldn't be as prudent of an investor or what have you, but I'd have maybe 10, 20% more funds. And that could be in a separate dividend portfolio yielding me way more money than I could need. And I could focus strictly on growth or, getting to the next level of where I want to be. So it keeps you thinking a little bit. And I encourage you guys to continue to think about it, because I think everyone just always assumes you have to go the dividend route. I'm not chasing, as you guys probably see, the yield that some of you guys may be. Some of you guys might be like, I need to go all JEPI, all QYLDs. I need to get that 10 to 11% dividend yield. I need to get those weird REITs that Darth Dividend always invests in. Things like that. And it's like, I used to do that. I used to chase, and it lost me money. I guarantee it. An opportunity cost. Maybe not lose money per se. I'm sure some of them I lost money in, but it definitely lost me some opportunity cost. So keep in mind, you have to set up the portfolio. You have to right size the portfolio, shape the portfolio for you, not for somebody else, and truly understand what is right for you. So just like investing in stocks might not be for anybody in general. It might be that you need hands-on. You want to put sweat equity into things. And that's when I would say you probably should do real estate, flipping, stuff like that. But me, I make the majority of my bread from a 9-to-5 job, engineering job, which I just came home from. And that's what puts food on the table most of the time. Focusing on that, 9 hours a day, 10 hours a day, however long you want to call it, is truly where I need to put my focus with, dividends eventually probably, or investing eventually, maybe taking up more of my time when I become kind of a career transition into more of like a full-time real estate investing sort of entrepreneur. But in the meantime, the best method for me is to put it into more passive investments. And so that's why I focus on the stock market. That's why you get videos like you see today. So really hope this video finds you guys well, with a little bit of, hey, that's really cool. It's a lot. It's a very big number, $5,500 in JEPI, God knows. But also some education towards the end and throughout about why I'm selling positions, why I'm consolidating, and giving you some of that, I don't want to say maturity, but reasoning, justification as to why the portfolio is shifting. It's very calculated, not very whimsical, right? And I encourage you guys to think about that as well. I'm not just doing it whimsically. Anytime I make a position change, when you think about it, it's called a position. It's like a piece on a chessboard. And I hope you guys think about it like that as well. And if you make a mistake, don't be afraid to cut it and, take that capital elsewhere. You can make, $20,000, $30,000 position is a lot to deal with. And that could be a huge, huge sum of money when it comes over to 10, 20, 30 years. And so don't just let it sit in a position that's going to flounder over time if you make the wrong decision. So anyway, hope this video finds you well. It ended up being 19 minutes anyway, but I hope you guys enjoy, and I hope you guys get great satisfaction out of it. Let me know if you guys have any questions in the comment section. Cheers, and I'll see you guys in the next video.